In this video, we're going to talk about the best investment opportunities for new and experienced investors on how to start building wealth. If you are interested in building wealth, you want to find an investment vehicle that is repeatable. That means that you can continue to buy regularly on these assets without too much difficulties, and also something that provides consistent returns over a long period of time. And this is how you would build wealth. Eventually, you want to kind of get this on autopilot. So that's the idea. Often people are confusing wealth with having a lot of cash. And to me, wealth is more about equity, and equity that is working for you. Why I'm not considering cash as wealth is because cash to me is really an investment in currency. If you have a lot of US dollars, I mean, you are investing in the US currency. Often people think of it as though having cash is being neutral, not being on the sideline, having a neutral investment. But it's not exactly neutral. When you have cash, what you're really doing is investing in that US currency, and the rate of return of that currency is really the inflation, which is right now is basically a negative 1.4% return. You're losing 1.4% of the value of your cash every year. The thing is that when people look at cash, they think, well, you know, nothing can go wrong. The U.S. economy is going to be strong. It's always, come out of economic trouble, etc. But that inflation rate is really what's eating up at your purchasing power with that currency. And this is why it's your rate of return. When you look at your bank account, if you had $1,000 last year, and you didn't spend it, you still have $1,000 this year because there's no interest in the bank. But also, this is what it looks like. It looks like you have the same amount of money. But in reality, when you go and spend that amount of money, you can't buy as much as you could last year. So for example, if you were able to buy a watch, let's say last year for $1,000, and now this same watch would be worth $1,014. Now you don't have enough money to buy that watch now. This is how the purchasing power works, and it works across everything that you buy. And that 1.4% is really assuming a basket of goods that the government has determined. But everybody's inflation rate in practice is different because you're buying different things. So as a good example, a couple of years ago I bought a Tesla, and then last year the cost of electricity was up 2.2%. But the price of gas for a car went down by 15%. So if I look at my neighbor who has a big pickup truck, his inflation might be less than mine because the price of running his vehicle was 15% cheaper for him, and it was 2.2% higher for me. So I may have a higher inflation rate than he does. And third is the government is printing a lot of money, and this is why a lot of people are worried about this stimulus package and the fact that the government is printing trillions of dollars of new money. I don't want to discuss here the merit of the stimulus package, but what I want to discuss is that the fact that this money is being printed and distributed means that we're increasing the supply of the US dollar. And what happens to the value of the US dollar when the supply increases? Like all supply demand curve, that means that the value of the US dollars would go down. This is why the printing of the money is what they call an inflationary, because it's gonna eventually generate inflation. It's gonna devalue or reduce the value or the purchasing power of the US dollar. So this is a long way to explain why I think cash should not be considered wealth. It should be really more considered an investment in the US currency, and this is why when I'm looking at wealth, I'm looking at the equity side of things, how much equity you have in different asset classes. This is what wealth is, and hopefully have that wealth work for you to generate passive income and achieve financial freedom is something that everybody should achieve and reach. So if I'm not going to invest in cash because of the negative return, so where should I invest? So let's talk about some of the key criteria that I think are important in an investment vehicle that's going to generate a lot of wealth. Number one is leverage. So leverage is very important because it allows you to put a small amount of money down and then borrow the rest, so you can buy a bigger asset that's going to appreciate over time, and that whole asset is appreciating, and you're paying the mortgage over a long period of time. So as an example, if you invest in real estate, you can put $20,000 down to buy a $100,000 property and you basically mortgage $80,000. The advantage of getting that larger asset is that appreciation works on the asset overall. So the appreciation would be calculated against $100,000, not the $20,000 that you put down. So that's really going to affect your cash on cash return. If you have any also rental income that's coming from that, or any other passive income that's coming from that, then you can get your cash on cash return is going to be also calculated based on the $20,000. So it's going to provide higher return than if you cannot use leverage and you have to put $100,000. The other advantage is that if you do have $100,000, instead of buying one asset at $100,000, now you can buy 5 of the same asset with that same $100,000. So that's a significant multiplying factor for your returns. Real estate is not the only place that has leverage. You can also use margin, for example, on stock market account, Forex also, and commodities also have different margin factors that you can use. On the stock market, I mean, the ones that I have basically have 100% margin. So if I put $20,000 down, I can buy $40,000 in stock. In Forex, I believe it can go as high as 5, and I think in commodities like 7 times the amount that you put down. So depending on some of the markets, depending on your account, depending on your experience and all of that. So there are other ways, there are other investment vehicles that you can use leverage with margin accounts. The problem that I see with margin accounts on the stock, Forex, or commodities is that if you go into a situation where the stock price or the value of your asset is goes below the margin, then you get what's called a margin call. And that could be anytime, any day, and then they would just contact you to basically have to put more money down by the end, by closing. Otherwise, they're going to start selling assets, and they're going to pick which asset they're going to sell. So that's the disadvantage of the margin on these kinds of the stock market or the Forex or commodities. If the value of your house goes down, if you continue to make mortgage payment, they're not going to foreclose on the property. We don't have mark-to-market anymore, so that's fine. You can still pay your mortgage and you still have the property. And this is a long-term investment as well, so eventually it's going to get back up to the value that you purchased the property for. The next investment criteria is along tax benefit, any kind of tax benefit that you can leverage with your investment. That would be fantastic, right? So making money is great, but the tax man for some reason shows up and want their share of the profit, but they didn't invest in anything. So I'd like to have some tax benefit whenever I invest in something. When you invest in stock, commodities, Forex, and all of that, so all these transactions are tracked, and then you can, you have capital gains that are associated with that. So some of them are short-term capital gains where they have a higher tax rate. You also have long-term, if you hold them for longer, obviously over a year, then you have a slightly lower income tax on these capital gains. So that's the difference here. And that's basically all there is to do on the stock market, commodities, all these trades that you're doing. Real estate is a little bit different. You have a significant amount of tax benefits just by using something that's called depreciation. So basically, you can depreciate the value of a house over 27.5 years, and that goes directly against the income that you would be making. So this is great. So if you have like a rental property and you're making $3,000 a year, and then you calculate your depreciation, your depreciation may be about $2,000 a year. So you only have to pay taxes on that $1,000 extra. Sometimes it works the other way actually, and you can actually go negative, and you can actually reduce your overall tax bill because you may have a negative profit, negative profit on that property after you've taken into consideration depreciation. On apartment buildings, some commercial, you can actually do something that's or component depreciation, and then you can do an accelerated depreciation with the bonus depreciation that was passed in 2018. So this is great because then now I can deduct a lot more of that depreciation in the first year that I bought the property. So this is fantastic. You don't have that in any other investments that I know of. If you know of another investment, please let me know in the comment. I would like to know more about that. Finally, the other criteria that I find very important is the ability to have multiple exit strategies. And with real estate, you can have multiple exit strategy. Even if you own a piece of property, let's say a single family home, you can use it for rentals. You can sell it to an owner that wants to move into the property. You can change the use, make it mixed use, or turn it into a commercial property. You can tear it down, build something else on top of that to find the highest and best use for that piece of land or that piece of property. So that's all the things that you can. There are other things that you can do as well, but there's multiple exit strategies for real estate. On the stock market, forex, and commodities, it's not that obvious. There are a couple of things that you can do. On the stock market, for example, if you own some shares of a stock, you can do something that's called covered calls. The amount of the exit strategies are fairly limited. So this is why real estate investing is so appealing to investors who are looking to build wealth. This is also how some self-made billionaires started and made their first million. Visual Capitalists actually created a chart based on a survey that was done on self-made multi-billionaires and how they made their first million. And also, how long did it take for them to make their first million? So many of them made their first million in real estate, and it took them 5.8 years in order to make their first million in real estate, which was faster than gambling, faster than finance, and faster than stock market investment. Faster than gambling at 9.5 years, and faster than stock market investment, which took 10 years in order to make their first million. The only three sectors that were faster than real estate were telecommunications, high tech, so basically creating a software mobile application, or gold mining, basically literally striking gold. That could be faster, but I think there's a little bit of luck involved. And finally, real estate is 5.8 was the number 4. So this is why I think when I'm looking at the best investing opportunities out there, it has to be real estate. You have to consider real estate as the number 1 investment that to look at in order to build wealth, or it should be a significant percentage of your portfolio. I hope you find this video enlightening and helpful, and that you learned something and maybe learned a little bit more why I consistently talk about real estate as a number 1 investment, number 1 go-to investment to generate wealth and achieve financial freedom. If you like this video, don't forget to click the like button. It really helps with the YouTube algorithm and expand the people that are seeing this video. If you like anything that relates to real estate, entrepreneurship, business, investment, feel free to look at the other videos on my channel. and don't forget to subscribe and to like my videos. So thank you very much.